The yield curve. You probably heard that term on the news, right? And usually it's mentioned with this kind of ominous tone, almost like a warning. Well, today we're going to pull back the curtain and show you exactly how this one simple line on a graph became one of the most powerful and honestly surprisingly accurate predictors in the entire world of finance.
So let me ask you this. Can one simple graph really predict the future of the economy? I mean, just a single line on a chart? It sounds almost like something out of science fiction, right? But stick with me for the next few minutes, because you're about to see just how incredibly powerful this thing really is.
All right, so let's jump in. The easiest way to think about the yield curve is like a financial crystal ball. No, seriously, it's this tool that all the experts, the economists, the big investors, they all use it to try and get a peek at what might be just around the corner for the economy. And this isn't some new trend or a fancy new algorithm. This is a tool that top economists and investors have been relying on for decades. When they start to feel like the economic weather is about to change, maybe a storm's brewing, this is one of the very first places they look for a sign. So, what is this mysterious graph? Well, it's called the yield curve. And I know that might sound a little intimidating or complex, but don't worry, we're about to break it down and make it super simple. Okay, so at its core, the yield curve is just a graph. That's all it is. And it's showing the relationship between just two things. First, you've got bond yields, which is really just a fancy way of saying interest rates. And second, you've got their maturities, which is just how long the loan is for. That's literally it. It's just a picture of interest rates over different periods of time. Let's break that down even more. Yield is just the reward, right? It's the interest you get for lending out your money. And maturity is just the time frame, how long you agree to lend it for. Think of it like this. If you lend a friend $20, you'd want more interest back if you're lending it to them for 10 years versus just 1 month, right? Of course you would. That's the basic common sense logic we're dealing with here.
Okay, so here's where it gets really interesting. The secret to the yield curve, the magic. It isn't about any one specific number on the graph. The whole story, the part that has all that predictive power, it's all about the shape of the curve. So most of the time, the curve looks like this. It slopes up. We call this a normal yield curve. And it makes total sense, right? It follows that logic we just talked about. If you're going to lock up your money for 30 years, you are going to demand a much higher interest rate, a higher yield, than for a loan that's only 3 months long. More time equals more risk, so you get more reward. Simple as that. But then, every now and then, the graph does something really weird. It flips. It goes completely upside down. We call this an inverted curve. And all of a sudden, lenders are getting paid more for short-term loans than for long-term ones. Now, why would this happen? Well, one big reason is when a central bank is jacking up short-term rates to fight off inflation, making it super expensive to borrow money in the here and now. But think about it. This completely goes against all common sense. And that right there is the key. This inversion thing, it isn't just some quirky piece of financial trivia. When the fundamental rules of lending get turned on their head like this, it's a huge blinking red light. It's a massive signal that the way investors feel about the future is changing in a big, big way. This is exactly where the yield curve gets its famous reputation. That strange, upside-down shape, that is precisely what economists are looking for. It's become the #1 leading indicator of a potential recession. You see, the yield curve is what we call a forward-looking tool. It's not just telling us what's happening in the economy today, it's dropping hints. It's giving us clues about where interest rates might be going and what the economy as a whole is going to look like down the road. Are we heading for a boom or are we heading for a bust? So you might be wondering, how does this inversion actually happen? Well, it's basically a chain reaction, and it's all driven by psychology. First, people start to get worried. Investors get nervous about the economy in the short term. So what do? They look for a safe place to park their money. This triggers what's called a flight to safety. They sell riskier stuff and pile into super safe long-term government bonds. And you know what happens when demand for something skyrockets, right? The price goes up. For bonds, a higher price means the yield, the interest rate, actually goes down. So all this demand pushes those long-term yields down, down, down until, bam, they drop below the short-term yields. The curve inverts. It's basically the entire market casting a collective vote of no confidence. And the track record here, honestly, it's just astonishing. An inverted yield curve has shown up before every single one of the last 7 major U.S. recessions. Let that sink in. 7 for 7. That is not a coincidence.
That is an incredibly powerful historical pattern, and it's why everyone, from the people at the Federal Reserve all the way down to your local news anchor, suddenly snaps to attention the moment it happens.
Okay, so this is all really fascinating stuff for economists and finance nerds. I get it. But let's bring this home. Let's talk about why you should care and connect this abstract graph to what really matters: your world, your wallet, and your life.
Well, here's why. An inverted curve, and the economic slowdown it's often pointing to, can have a direct impact on the interest rates you'll pay for a mortgage or a car loan or even on your credit cards. It can influence whether the companies in your area are hiring or laying people off. And it just plain affects the overall confidence that you and I feel when we have to make big financial decisions. Now, I want to be really clear about this. It is not a 100% guarantee. No crystal ball is ever perfect, right? Sometimes the timing's a little off, or maybe the recession it predicts turns out to be pretty mild. So it's better to think of it less like an ironclad prophecy and more like seeing smoke on the horizon. It's a powerful, historically reliable warning sign that tells us, hey, it's time to start paying very close attention. So, from now on, when you hear that phrase on the news, the yield curve, you won't just see a squiggly line on a screen. You'll understand the incredible story that it's telling, a story about confidence, about fear, and about the potential direction of our shared economic future. So I'll leave you with this. The next time you see it, will you see it as just a graph, or will you see it as a story about what's coming next?